Hello, my name is Peter Mothy. I wanted to share with you some thoughts today on lost decades in the stock market. This came up recently in a discussion. A diagram such as this came up, and I noted the pattern to a number of investors I was speaking with about the lost decades. It's a common term in the industry, and you can see the lost decades or more. For example, the lost decade in the early part of the 20th century was nearly 30 years. The next one was nearly 20 years. And as we go on in time, we've had further lost decades. This one that lasted from 2000 to 2013. And here again, it looks like we may be approaching the time for another lost decade. This pattern is identified simply because we have long bull markets, which are built of great expectations and great earnings growth in the companies that are publicly traded. And then we have long periods of waiting for those expectations to be met. Now, pay attention to this, because if you're an investor that's a buy and hold investor and have been lulled to sleep about the risks in the market, think about what a sideways market for 10 or 15 years might do to your retirement. On the other hand, if you're an active investor or one who is dynamic about recognizing that there are times to be heavily invested in stocks and times to be heavily invested in bonds, and sometimes even more so in alternatives, well, these sideways patterns don't really mean anything to you because your portfolios are robust enough to avoid the pitfalls of the lost decades. Let's take a closer look. This is a view of the last two decades. This goes back to 1990. The last two bear markets were from 2000 to 2003, and then from 2007 to 2009. Note that the 50% decline in the first bear market was because historically, the stock market has taken out the available leverage in the stock market during bear markets. A case in point, in 1929, investors were allowed to borrow 90 cents on the dollar. After the 90% decline in the stock market in the crash of 1929, that was changed, and investors have only been allowed to borrow 50 cents on the dollar, or 50% since then. Therefore, almost all of the bear markets since 1929 have been contained within a decline of 50% or less. Well, that started to change in the financial crisis when we saw a 55% decline. And I believe the next one will be closer to 60%, as shown here in the upper right-hand corner. That means the stock market is likely to see, basis the S&P 500, something close to somewhere in the 1800 to 2000 level when the next bear market is over. Now, that's simply because in this period of time here, we invented new ways to add leverage without margin. We have leveraged ETFs. We have stock options. We have financial futures on the stock market. We have swaps that are traded by institutions on the stock market that provide great leverage. And I think that the next bear market, in order to take out all of the leverage that's been built up since 2009, is probably going to be about 60%. I often get the pushback that, well, what about earnings? And earnings, just think about what the PE is going to be if we have a 60% decline in the stock market. And I said, well, don't forget, earnings also follow this pattern. Notice how flat earnings were from 1929 until the early 1950s. Then during the late 1960s and 70s, look at this. These are the S&P 500 earnings. We had the same lost decade in earnings as we had in stock prices. And the big decline in earnings came in 1929 and during the financial crisis. So earnings go through the same type of consolidation or decline that the stock market goes down. So seeing a decline in earnings and a decline in price means that PEs will decline, but not as much as you think with a 60% decline in the stock. I hope this gives you something to think about today. Good luck.